You were doing fine until you hit the number. You were browsing listings, getting excited, maybe even going to a couple of open houses, letting yourself imagine furniture placement and morning routines in rooms that did not yet belong to you. And then someone, a colleague, a parent, a comment on a YouTube video, mentioned the 20% rule, 20% down, on a $400,000 home. That is $80,000. Cash, before closing costs, before moving expenses, before the things you are going to need to buy for a house you do not yet own, and something deflated, not completely, but enough that the open house visit started feeling like window shopping rather than research, enough that the whole conversation about buying a home moved into the category of someday instead of now. Here is what I need to tell you in the first 60 seconds of this video, before anything else. The 20% rule is not a rule. It is a myth, a financially convenient myth that has caused millions of qualified buyers to delay home ownership by years, sometimes by an entire decade, while they chase a number they were never legally required to have. But here is the twist that makes this more complicated than us saying you do not need 20%. There is a version of this math where putting less than 20% down is genuinely the right call, and there is a version where it quietly destroys your finances over time. And the difference between those two versions is something almost nobody in the mortgage industry will sit down and walk you through honestly, because they get paid the same either way. That is what this video is for. My name is Sig, and I spend way too much time thinking about money, the specific ways standard financial advice either helps or quietly misleads regular people, and the home buying process in particular, which contains more mathematical complexity and more motivated parties with financial incentives that do not fully align with yours than almost any other single transaction in your life. If you are trying to figure out how much you actually need to put down on a home in 2026, not what sounds responsible, not what your parents said, not what the 20% myth implies, but what the real math says for your specific situation, subscribe to this channel right now and give this video a thumbs up if it gives you something. The mortgage broker's brochure never will. The honest calculation. Let me start by killing the myth properly rather than just dismissing it, because understanding where it came from explains exactly why it persists so stubbornly, even though it has not been legally required for decades. Before private mortgage insurance existed as a product, lenders required large down payments as their only protection against a buyer defaulting and the bank being unable to recover the full loan amount through a sale of the property. 20% equity meant the bank could sell the home at a loss of up to 20% of its value and still break even. The bank was protecting itself using your money because there was no other mechanism available. PMI changed that. Private mortgage insurance allowed lenders to accept smaller down payments by transferring the lender's risk to an insurance product. The legal minimum down payment on a conventional loan dropped. On FHA loans, it dropped to 3.5%. On VA loans for veterans, it dropped to 0. On USDA loans for eligible rural and suburban areas, it dropped to 0. The 20% requirement became obsolete as a legal standard, but it survived as a cultural standard because it served certain interests to keep it alive. Sellers prefer buyers with larger down payments because they signal financial strength and reduce the likelihood of the deal falling through for financing reasons. Real estate agents prefer larger transactions because their commission is based on sale price. Lenders make more money on larger loan amounts. The 20% myth, while no longer legally necessary, remained useful to enough parties in the transaction that nobody with a financial incentive to correct it was in a position to do so loudly. So it persisted, and it is still stopping qualified buyers today. Here is the reality of what buyers are actually doing in 2026, because the data completely undermines the 20% myth in real terms. According to the National Association of Realtors, the median down payment for first-time buyers in 2025 and into 2026 approximately 9 to 10%, not 20, 9 to 10. The median nationwide down payment reached approximately $62,000 in mid-2025 across all buyers, which, on a $400,000 home represents roughly 15 to 16%. First-time buyers specifically are putting down closer to $35,000 to $40,000, which on a $400,000 home is closer to 9 or 10%. Nearly one-third of prospective home buyers, according to a Freddie Mac survey, still believe they need a 20% down payment to buy a home. That belief is causing a significant portion of qualified buyers to delay or abandon homeownership entirely, while they save toward a target they were never legally required to reach. The gap between what buyers believe they need and what they actually need is not a minor misunderstanding. It is a myth that is actively reshaping the financial trajectories of millions of people in a direction that does not serve them. Let me show you the actual math on different down payment levels on a $440,000 home, which is the current national median home price, at a 6.5% interest rate, because this is where the real complexity lives and where almost nobody gives you a complete honest picture. Scenario 1 is 20% down. That is $88,000 out of pocket. Your loan amount is $352,000. Your monthly principal and interest payment is approximately $2,227. No PMI required. Total monthly housing costs before taxes and insurance, approximately $2,227. Scenario 2 is 10% down. That is $44,000 out of pocket. Your loan amount is $396,000. Your monthly principal and interest payment is approximately $2,505. PMI at a rate of approximately 0.7% annually adds approximately $231 per month. Total monthly costs before taxes and insurance, approximately $2,736. That is a difference of approximately $500 per month compared to 20% down. Scenario 3 is 5% down. That is $22,000 out of pocket. Your loan amount is $418,000. Monthly principal and interest at approximately $2,650. PMI at approximately 0.85% adds approximately $296 per month. Total monthly costs before taxes and insurance, approximately $2,946. That is a difference of approximately $720 per month compared to 20% down. These numbers are real and they matter. But here is what most people never see alongside these numbers, and it is the part that changes the entire decision. Let me introduce Marcus. Marcus is 32. He has been saving aggressively toward a home purchase for 3 years and has accumulated $88,000, which is exactly the 20% he believes he needs for the $440,000 home he wants to buy. His friend David is in the same situation, except David decided 18 months ago that he did not need to reach 20% before buying. David put 10% down, $44,000, bought the same style of home in a similar neighborhood, and has been making his higher monthly payment including PMI for 18 months. Here is what the math says about these two different paths over the same 18-month period. David bought the home 18 months ago, assuming a modest 4% annual appreciation on his $440,000 purchase. His home is now worth approximately $472,000. He has gained approximately $32,000 in equity through appreciation alone, on top of whatever principal he has paid down over the same period. Marcus spent those same 18 months continuing to save, continuing to rent, and continuing to watch housing prices in his market move. He did not buy. He has his $88,000 in savings. He has not gained any housing equity because he does not own any housing. The comparison is not about who is richer right now in some abstract sense. It is about the fact that David's decision to buy, with 10% down and pay PMI for the first few years of his loan gave him access to an appreciating asset 18 months earlier than the 20% myth would have allowed. And that 18-month difference in market entry produced a real, calculable financial outcome that the monthly PMI cost did not erase. Let me be specific about PMI, because it is the central villain in the 20% myth. and understanding what it actually is changes how you think about paying it. PMI is private mortgage insurance. It is a premium you pay monthly to an insurance company that protects your lender, not you, in the event that you default on your loan and the home sells for less than you owe. This is the part that feels infuriating when you first hear it. You are paying monthly premiums on an insurance policy that does not protect you at all. It protects the bank, and that framing makes PMI feel like a pure punishment for not having enough money, which is exactly why the 20% myth presents it as something to be avoided at almost any cost. But here is the reframe that changes the calculus. PMI is not forever. On a conventional loan, PMI is automatically canceled when your loan-to-value ratio reaches 78%, meaning when you owe less than 78% of the home's original value. You can also request cancellation once you reach 20% equity, either through payments or through appreciation, whichever comes first. And in a market where home values are appreciating, 20% equity can arrive faster than your payment schedule alone would suggest. On a $440,000 home with 10% down, if the home appreciates at 4% annually, you reach 20% equity and can request PMI cancellation in approximately 3 to 4 years from purchase. Even if you made no extra payments, the monthly cost of PMI during that 3 to 4 year window is real money. On a $400,000 loan at approximately 0.7% annually, it is approximately $233 per month, or approximately $8,400 over 3 years. That is the actual cost of buying with 10% instead of 20%. If you remove it at the earliest opportunity, $8,400 over 3 years on a $440,000 asset that has appreciated by approximately $53,000 over the same period. The math is not as one-sided as the 20% myth implies. Here is where I have to stop and be completely honest, because this video is not an argument that you should always put as little down as possible. There are specific situations where a lower down payment is genuinely the wrong financial decision, and I want to name them directly. So, the nuance of this conversation is real, rather than just cheerleading for buying with less. The first situation is when putting less than 20% down makes your monthly housing cost exceed approximately 30% of your actual take-home pay, not gross income, take-home. If the higher monthly cost of a smaller down payment pushes your housing cost-to-income ratio into territory where you have no financial breathing room, the PMI is not the problem. The purchase itself may not be financially supportable at any down payment level right now. The second situation is when you have no emergency fund remaining after the down payment. Buying a home with 5% down and $0 left in savings is an extremely vulnerable financial position. The first significant maintenance expense, a furnace replacement, a plumbing issue, a roof repair, becomes a credit card emergency rather than a planned expense. The third situation is when you are buying FHA rather than conventional. FHA loans require mortgage insurance for the entire life of the loan in most cases, not just until you reach 20% equity. The long-term cost of FHA mortgage insurance is substantially higher than conventional PMI and changes the calculation significantly. If you are in an FHA scenario, the math on PMI duration works very differently than I have described for conventional loans. Here is something that most down payment conversations completely ignore, and it is the category of costs that actually surprises buyers more than any other part of the home buying process. Closing costs. On a $440,000 home, closing costs typically run between 2 and 5% of the purchase price. That is between $8,800 and $22,000, due at closing in addition to your down payment. This number catches buyers completely off guard, in a way that the down payment, which they have been mentally prepared for, never does. Closing costs include lender fees, origination charges, title insurance, appraisal fees, attorney fees in states where they are required, prepaid property taxes, prepaid homeowners insurance, and a handful of other items that add up much faster than buyers anticipate. Many first-time buyers deplete their savings, reaching their down payment target, and then discover they also need tens of thousands of dollars more at closing that they did not plan for. Understanding the true total cash needed at closing, down payment plus closing costs, is the only way to honestly assess whether you are financially ready to buy right now, regardless of whether that down payment is 5%, 10%, or 20%. Let me give you the specific question that you should be asking at every mortgage conversation that almost nobody thinks to ask. It is not what is my monthly payment. It is not what is my interest rate. The question is, what is the total cost of this loan over its full term? And how does that compare to the alternative? Lenders are required by law to provide you a loan estimate document that includes the total amount you will pay over the life of the loan. This number is often shocking, and almost nobody reads it carefully. On a $396,000 loan at 6.5%, over 30 years, the total amount paid in principal and interest alone is approximately $898,000. You borrowed $396,000, and you pay back $898,000. The difference is $502,000 in interest payments over 30 years. This is not an argument against buying a home. Home appreciation, tax advantages, and the forced savings mechanism of a mortgage payment all exist as real counterweights to that interest cost. But understanding the true total cost of the loan, rather than just the monthly payment, is the only way to make a genuinely informed decision about your down payment level, your loan term, and whether this specific purchase at this specific price makes financial sense for your specific situation. Let me give you the actual framework for deciding your down payment, rather than defaulting to a myth on one side or a cheerful minimum down marketing pitch on the other. The right down payment for your situation is the amount that satisfies all of the following conditions simultaneously. First, after the down payment and closing costs are paid, you still have a minimum of 3 to 6 months of living expenses in liquid savings, not invested, liquid, accessible without selling anything. Second, the resulting monthly housing cost including principal, interest, property taxes, insurance, PMI if applicable, and a maintenance reserve, stays at or below 30% of your actual take-home pay. Third, you are not pausing or suspending retirement contributions to reach the down payment target or to manage the monthly cost after closing. Fourth, you have a realistic expectation that you will stay in the home long enough for the purchase to make financial sense. Minimum 5 years, ideally longer in the current market environment, if the minimum down payment required by your loan type allows you to satisfy all 4 of those conditions, while also entering the market sooner and beginning to build equity in an appreciating asset, then the lower down payment may genuinely be the better financial decision. If reaching any of those conditions requires a larger down payment than the minimum, then saving longer toward a higher down payment is the more honest answer. Regardless of what the 20% myth says, the 20% myth stopped you. It was designed to seem responsible, to seem like the conservative and financially disciplined choice, to seem like proof that you have your finances together before making the largest purchase of your life. And in some situations, it is exactly that. But in a market where home prices have increased 50% since 2020, where the median first-time buyer is putting down 9 to 10%, where conventional loans allow as little as 3% down for qualified buyers, where PMI cancels automatically once you build equity, and where delaying homeownership by 2 or 3 years to reach an arbitrary threshold means 2 or 3 more years of appreciation you did not participate in. The 20% rule is not always the conservative choice. Sometimes waiting is the expensive choice. Sometimes the math says buy sooner with less down and remove the PMI in 4 years. Sometimes it says save more because your monthly cost at the current price and current down payment does not fit your financial life without serious stress. The answer is never the myth. The answer is always the math. And now you have the framework to do the math honestly for your specific situation. rather than letting a number someone told you at a family dinner make the decision for you.